Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for the week ending on June 17th. My name is Ian Saunders, and we're joined as well again today by Will Gibson. And Will, coming in to movement, at least at the time of this recording here on Thursday, June 16th, the afternoon of Thursday, June 16th, a pretty sharply negative day for most of the broader global equity space, which almost feels repetitive to say at this point. I mean, you've had some upside participation. We got a little bit of upside participation for many of the major indices after the Fed raised rates yesterday by 75 basis points. Which, I mean, we were talking about this last week or even 2 weeks ago. You wouldn't really have thought that was going to happen. Yeah. A lot has changed over the course of the past couple of weeks here, and we've seen a lot change kind of to the downside for most of the broader equity picture.
Yeah, it's not been a fun year unless you own only energy. But
Right.
It's not been a fun year for your major equities today. Just kind of furthering that, like you mentioned yesterday, you got that short rally after the Fed announcement, and then that was quickly sold off. Overnight futures, morning futures turned negative pretty sharply, and that's continued throughout the day. We really haven't seen any type of intraday recovery here, and even like week by week now, I feel we've talked about every week. I think it's like 10 or 11 weeks now, not consecutive. You had that 1 week of a positive gain, and other than that, it's been downhill.
Yeah, it's been a rough day this afternoon as well, at least at the time of this recording on Thursday afternoon. I mean, we're looking at the S&P 500 is down over 3%, the Nasdaq, broader Nasdaq composites down another 4%, and even the Dow's down over 2.5% right now. I mean, and then looking at the S&P, right? S&P, that big core market index that everybody knows and sometimes loves, maybe not right now, but did see the S&P 500 enter an official, what most would classify at least as an official bear market with trading on Monday of this week, right? So we saw the S&P had shown a decline at that point of around 21%, which officially entered that classic 20% drawdown from high, which the high for the S&P was, interestingly enough, the first trading day of this year was the all-time high for the S&P 500 on January 3rd. We've seen it decline at this point over 22%. From that high to the current chart level. If you're looking at it on a point and figure chart, we like to use a little bit of a longer term scale, especially when we're getting this major movement over the course of the past couple of weeks. That longer term scale, kind of that 50-point chart scale, is the one that we typically been monitoring. We did see that chart did move to an overall negative trend with movement there on that 50-point chart towards the end of May. We then saw a sell signal that was given there with movement over the course of the past couple weeks. And then finally, with movement over the past few days, we dropped down to a current chart position there at 3,700. So on Monday, we were looking at support at the 3,750 point, further support at 3,700. We've obviously now violated that 3,750 support. So we're looking at the support from January of last year at the 3,700 mark. So we did break beneath that with trading on Thursday afternoon, but we haven't shown enough for a deterioration beneath that to lead to an extra O being given on that 50-point chart, right? The point and figure methodology and looking at that 50-point scale, we need to get below 3650 in order to print an additional O and kind of take out that support that's been built up over the course of the past 18 months, right? Looking down beneath that, I mean, we had a piece coming out on Monday. We looked at some historical stats around the prior bear markets, as well as kind of updating some support levels for the S&P. And so we'll get to the bear market stuff in just a sec. But with some of those support levels, I mean, you might see some support around the 3,500 mark, which was the kind of resistance point that we got to back in September and October of 2020, right? But there does seem to be some solid support baked in there at the 3,250 mark, which is that support level that we hit a couple times back in that late 2020, beginning of Q4 2020 environment. I mean, it feels bad to say looking at support that far down. That is a pretty deep drop from these levels for sure.
Oh, yeah, certainly. And when you're looking at these P&F charts, a lot of those column reversals, those exhales into O's have been just that for a lot of the past couple of years, just simply exhales and not material tests of buyers and seller dynamic or material tests of support. I would say that 3,700 level, which we were around and kind of violated through, that was probably one of your first material tests of some old support. That was February, March of 21. And then Ian, like you mentioned, that resistance from September of 2020. And then beyond that, the low of September 2020, I would say that's another meaningful area of support to keep on your radar for this one.
Yeah, absolutely. And I mean that support that we're looking at from that September, October low, right? If we did hit that point, I mean, we're looking at a 32% peak to trough drawdown. If that was the trough, we're looking at a 32% peak to trough drawdown for the S&P 500, which it's kind of, when you would look at historical bear markets, I mean, there's been a total of, in looking at this, been a total of, what was the number there? I believe it was 26 bear markets since 1927, which we're classifying a bear market. This isn't just to say a bear market environment, right? Because you look at 2008 through 2009, I mean, there are a few bear markets kind of baked into there.
Yeah.
So we're classifying a bear market as a 20% peak to trough drawdown, followed by a subsequent trough to a subsequent rally, rather, of another 20%. So you draw down 20%, you get a 20% bounce. That's one period. If you go down another 20% for there and then up another 20% in the same year or 18 months, that's a second period. And at least in some of the testing that we've done, just to provide some perspective around it. So there's been 26 such events since 1927. The last one we saw prior to this, everybody knows well, was March 2020. And in that time frame, we were down 34%. So very quick, very sharp down, very sharp up. But an ultimate drawdown was 34%. I mean, if we get to that 3250 level, we'd be at 32%, which is in the same ballpark, at least. And we see a lot of the same kind of mark, at least from many of the other prior bear market environments, that 30 to 35 kind of, sometimes upper 30s, but that level seems to be a pretty kind of consistent down move. And we've had some that have certainly gone much lower, and some that have just hit 20% almost on a dot and then turn around and gone right back up, which fortunately was not the case this time. But just something to note. I mean, when you're looking at these support levels, I mean, it just something to note kind of moving forward, that historical, we don't always see history repeat itself, but at least we can provide some precedents to kind of look toward.
Yeah, definitely. And if you're watching this on YouTube, we'll throw up one of the images from the report that we put together that looked at kind of by decade, the types of bear markets that we saw and how much worse it got. So after that 20% mark, how much more downside did you have to take on average? And we looked at that by decade. So that's helpful to kind of visualize as well here. Something else that I'll tack on, Ian, you reminded me about the velocity of that 2020 sell-off, and then the velocity of the recovery. Periods like that are really tough for strategies like ours, momentum trend-based strategies, when you get those really quick, sharp changes of direction. This year, not to say that it hasn't been as high velocity, but it's been a bit more, it's been a bit slower of a roll-off period, I would say. So there has been time to position more favorably in certain sectors or asset classes as a whole. So for our sake, I say I'm a bit thankful for this type of environment. We would rather have something like this and these really quick elevator moves.
Yeah, I mean, and another, you bring up a good point there, that I mean, the velocity of 2020 is the freshest bear market in anybody's mind, right? But I mean, it's so much more rapid than we typically see in the bear market environment. I mean, you even average from the time you hit that 20% drawdown to the ultimate trough, you have an average of about 100 days in that span, looking at historical, those 26 historical timeframes, 68 days from a median perspective. We saw, I think 11 in 2020. I mean, that's just kind of outside the norm. And so we might not have 100 days this time, but it's just something to look toward. You typically do see a little bit more of a drawn out environment, like you said.
Yeah, and especially when you get markets in these heavily oversold conditions, which we'll talk about towards the end of our podcast today. You see more volatility. It's typical to see that you get big clusters of really good and really bad days together. Yeah. So yeah, there's a lot of recency bias, a lot of anomalies that are being extrapolated from those recent events. I think maybe get a healthy perspective.
Yeah, absolutely. I mean, you talk about things that have been a little bit more drawn out. I mean, you looking, the S&P is one, but looking at the Nasdaq, right?
Yeah.
I mean, we just moved into a bear market in the S&P. Nasdaq has been in a bear market environment, right? I mean, you look at the Nasdaq 100, moved into a bear market a couple months ago. You look at the broader Nasdaq Composite Index, now 29% year to date. Interestingly enough, looking at them over the past 30 days, we've seen the S&P underperform the Nasdaq Composite. S&P's down almost 5.5%, not including Thursday's action. On a trailing 30-day time frame, the Nasdaq Composite's still down 4.8%, and not down quite as much.
Yeah.
But I mean, we've seen that technical picture for that Nasdaq Composite Index. I mean, it's certainly shown some pretty some much more notable and much more kind of consistent down moves over the course of the past few months here.
Yeah, definitely. And when you're looking at the chart now, I have the 100-point chart pulled up here that I'll show on YouTube as well. But we're actually at those September 2020 lows on that Nasdaq Composite, around 10,600, 10,500 in that ballpark right now. So as we said before, I think this is probably an important level to keep mind of on your Nasdaq Composite. Talk about a meaningful test of support. I think we've arrived to at least one of those right here.
Yeah. I mean, you're looking at it on the chart. I mean, it certainly looks pretty meaningful.
Yeah.
The support levels kind of baked into there. I mean, the other point, like you mentioned, I mean, we're seeing both of these broader indices get into kind of that oversold condition, right? We're down around negative 100% reading from a weekly overbought oversold standpoint, or 100% oversold, as we would say. I mean, it's not something we typically see all that hang around at those levels all that frequently. So it's something you kind of could look toward, a potential for. We do see a little bit of a bounce like we saw yesterday, right? With some of the major indices up over 1%, up over 2%. But the current state of those kind of broader, longer term technical pictures on some of these longer term chart scales, I mean, we have recency bias with the 2020 V-shaped recovery, but we haven't seen that kind of V-shaped down move, and certainly not looking like we're at least could expect that V-shape up move moving forward.
Yeah. So it'll be tough when you have these near-term oversold conditions, that the probability of those near-term bounces become higher. It's the re-emergence of a new trend that you're going to have to wait on for a lot of these. So should you get these bounces out of heavily oversold territory, we would say take it as an opportunity to sell weak positions on those rallies. And then with your strong positions, strong sector, strong stocks, when you're getting these big down days, maybe more of a buy on pullback. So try to discern those out. Yeah,
absolutely. I mean, and looking at some of the other indicators and rankings and stuff that we have on the site, I mean, you see this overall theme of some specific areas kind of carried over, portrayed across, right? I mean, you look at the asset class group scores page, right? We have 134 different groups that we track ETFs and mutual funds on that ranking. One of the most important ones that we look at is that S&P 500 index funds group, which we use as our U.S. core equity representative for some of the cash triggers that we have on the platform. But that S&P 500 index funds group did fall to a score reading of 2.89 over the course of the past week, actually through market action there on Wednesday, which fell below the 3.0 environment for the first time since 2018, I believe. We also see that group is kind of getting down into more oversold conditions from an average oversold standpoint. But even though it's shown weakness, it's shown deterioration, it's down beneath 3.0, it is still the 27th highest ranked group of any of the 134 groups in the system. I mean, I think that really, we still have the U.S. equity 4% rank up there at 82%. Above the money market, that cash proxy at 69%. I mean, some of that may change with the movement that we're seeing today. I mean, it's been changing a lot over the course of the past few days, but that's another important thing to notice, that there's just not that much doing well right now, right? If you're outside the commodities related areas, there's not a ton of other areas that you can kind of look towards by nature of that group scores, and seen a lot of stuff show some pretty sharp deterioration. Yeah,
to your point, there's really been nowhere to hide. Bonds mainly have been horrible, unless you're inverse fixed income, which is among the top of our rankings. And then, like you said, commodities. You have some defensive sectors above that S&P group. You have utilities, staples, some areas like that have been holding up a little bit better. But to your point, there's just really been nowhere to hide. And relatively speaking, that group's still sitting kind of elevated in the group score rankings. That absolute score deterioration beneath 3.0 is important. Like you said, the last time you saw that group go below was 2018. Prior to that, you saw some double dips in 2015 and 2016. We've seen some kind of parallel indicator movement to that time period. So maybe that's something we can explore a little bit more, which is something to note. Something else that I was going to mention as well, apart from that S&P 500 index funds group, if you look at the all equity funds, so every single equity fund that we're tracking on our system, that average score is down at 2.4, which is about the low you saw in March of 2020. So you're within hundredths of a point, really, of your all equity funds matching its lowest score since March of 2020. After that, interestingly enough, was 2016. So 2015, 2016, you saw a dip a couple times down there.
Interesting. Yeah. And I mean, you're looking at, you were looking at that all equity fund picture, right? I mean, there's a lot of areas that have shown a lot of deterioration, which maybe get into some of those in a sec, but there's some that are still hanging around. I mean, we do see there's four value related groups that are scoring north of the S&P 500, four that still have a position above the 3.0 score line. I mean, you're looking at all value funds, you're looking at large cap value, mid cap value, sector value. I mean, those value related areas, I mean, we've been harping on this for the course of the past several weeks and kind of several months here, but it's a trend it's not showing as much deterioration. It's showing drops, right? It is declining, but it's not showing as much kind of technical deterioration as some of the other areas that we're looking at on the system.
Yeah, certainly. They've held up relatively better than the growth-centric areas.
Yeah, I mean, you look at growth today, I mean, but technology being the classic growth-related sector there. I mean, you're looking at a recent group score for technology, 1.33. Right, the lowest score we've ever seen for technology was in 2004 at 1.28. So we're right around that territory. And you look back at some of those other historical score movements. I mean, we saw some pretty sharp score deterioration, obviously, in that early 2000s timeframe, pretty sharp score deterioration around that 2008, 2009 timeframe. But when you're looking back at the early 2000s, when we did see deterioration and then a bounce higher, it's not like we were going straight back up above 4. Right? I mean, we saw the group kind of go back up towards 3 and then kind of peter around in that score territory around that kind of 2.5 to 3, sometimes a little bit higher from that zone. So even if we do see some improvement, and technology has shown so much deterioration, other areas have been a bit worse over the past couple of weeks, right? That even if we do see a bit of a bounce, if we some return to the upside there, and you really want to look at that, like Will was saying earlier, look at that, like that changing in trend, right? That flip to the positive side, which it hasn't just been there on any of these kind of bounces for those spaces.
Yeah, and those spaces are going to take a lot of work, to be honest. I mean, a lot of absolute improvement, a lot of relative improvement to work their way back up in some of our rankings. Maybe we can now kind of dive into a bit closer on some of these sectors, like what's happening and what we mean by the lack of participation in there. So if we're looking at like bullish percent indicators, getting a bit more focused within sectors or a bit more focused within groups, we'll take the Nasdaq 100 to start with. Intraday calculation is at 9.8%. That means less than 10% of stocks are sitting on point and figure buy signals within the Nasdaq 100. So
probably around like 9 or 10 stocks in general, right? I mean,
right. We'll call it 9 or 10 stocks are sitting on point and figure buy signals for the Nasdaq 100 right now. And if you look at some of the sectors with the worst participation, it's a ton of technology and a ton of consumer discretionary. And that's been the theme for the whole year. So if you run down our sector bullish percents here, starting with the top, you got oil services at 55 and 46% respectively. No surprise there. Your next best sector in terms of stock participation is banks, and it's at 34%. So you have energy around half of stocks on buy signals, holding above support. And then after that, 2/3 or more of sectors are on point figure sell signals.
Wow. It's a lot of deterioration. That kind of speaks to the broader, it's been a very difficult kind of environment to capitalize on areas that have maintained strength. I mean, it's why we're seeing a lot of the kind of broader sector focused models we have. I mean, over allocation towards commodity related areas, over allocation towards your industrials or basic materials, you're like kind of some of the staples environments too. But I mean, kind of avoiding those areas of weakness, kind of like we're saying, using some potential bounces to move out of those is certainly good. Could provide some opportunity for at least boost some areas here the next moving forward.
Right. And on that bullish percent theme, going a step further, if you look at some historical extreme market environments, there's been a lot of comparisons to 2020, 2018, end of 2018. That is, you got 15, 16 in there and throughout. But if you look at the bullish percent historically, so has it gotten worse? Yes. Could it get worse? Yes. For example, your March 2020 low, you had 10% average across the board of all stocks on point and figure sell signal, or excuse me, point and figure buy signal, just 10% of names, March of 2020. Currently, we're at 25% across all the sectors. So notably higher from that. If you want to take a not as extreme example, you can look at like December of 2018, you had about 16% of stocks on point figure buy signals there. So today we'll push that lower, maybe 20%, south of 20%. So we could be getting to match some of the extreme washed out levels.
And as we'll say, just because just because we're washed out doesn't mean you can be. I mean, these indicators, just because they're so low, it doesn't mean they can't go lower. And every kind of push lower from here. I mean, if you're moving from 10% to 5%, right? Or from 12% to 6%. It's only a few boxes on the chart, but that's half of the stocks that are currently on moving lower. So I mean, that weakness can certainly feel pretty sharp when you're moving down at these kind of washed out conditions.
Yeah, for sure. And we said these things can hang down there for long periods of time. It's not uncommon to see them chop around in these low field positions. It doesn't mean that when we're looking for these reversals up, that it's not a good buying opportunity. Just know that it's likely to remain volatile, maybe get another buying opportunity down the road.
Absolutely. And like Will said, when you're looking at a buying opportunity, right? I mean, this is not the time to be, okay, you see a reversal up, all of a sudden just start jumping at anything that moves on the page, right? I mean, you want to be looking at those higher relative strength areas. One thing we have seen in these near-term rebounds or these rallies, that the relative strength from a sector and from a size and style perspective has remained pretty consistent. Right. You've seen the value names hold up a lot better in declines, and they've seen improvement kind of more on a consistent basis, more technical strength, right? I mean, on the sector side, you're looking at those commodity related areas, basic materials. They haven't shown quite as much deterioration, and they've held up better and seen more kind of upside movement potentially on some of these stretches of rallies that we've gotten. So if we do get some indicator reversals from these washed up territories, at least based upon the indicator readings that we're seeing now, I mean, those are the areas you want to focus on, those areas of strength if you're looking to start to add some exposure back into the market.
Yeah. And we get a lot of questions. How long are you guys going to be overweight energy and materials, and when do I start picking up some of these sectors? And we're saying we're going to stay there until the market tells us otherwise.
Exactly.
So we haven't seen that change yet, and we're going to stay with those areas of the market, asset class. Well as you were mentioning, stick with that until shown otherwise that the demand picture is changing. And when it does, you'll hear about it, podcast reports. A lot of the images that we show are from the report. So if you ever want to use those as collateral, that's a good place to find them.
Yeah, absolutely. Like we'll say, I mean, we'll continue to keep you up to date as we see any of this movement shifts. I'm sure that, it seems like we started every podcast over the course of the month of 2020 with a lot of movement over the course of the past week. So I'm sure we will be back next week with the same opening statement. Maybe we jinx us for the better this time. We'll see.
Maybe we come on and we say we don't have anything to talk about, and we run through our favorite images and funny charts for the week.
Yeah, absolutely. We do include some funny charts and some other commentary that we give out. The NEW Light shout out though. Yeah. So if you're interested in some funny charts and stuff in there, give us a shout and tell us you're interested in that. We can shoot it for you there. Maybe we'll have an NEW Light podcast that we can start coming out.
That's a good idea. Yeah.
Cool.
But talk to the people about that.
Yeah. But other than that, I mean, of course, if you all have any questions on anything, those that are subscribers to the research, you do kind of have an open access to us on the analyst side. We'll try to keep you updated there in the research. But any kind of questions you're seeing or stuff that you want to maybe hear us talk about on the podcast, let us know, right? Reach out to us via email, reach out to us over the phone. Those numbers are available there on the platform at DorseyWright.com. So other than that, I want to thank everyone for joining us again this week, and we will talk to you again next week.